Welcome to Real Estate Accredited. I'm Jeff Rodriguez, accompanied by my co-host Philip Schuligan. We are founders of Boost Capital Group, a firm that helps busy professionals invest in alternative assets. We have Real Estate Accredited to go over the nuts and bolts of real estate investing, whether you're a passive or active investor. We hold this meetup on Thursday evening, 7 p.m. Eastern Standard Time on a weekly basis. Today, we are going to go over the impact of interest rates on real estate investments. Slide. So the impacts of real estate investing on the cost of debt. So plain and simple, when interest rates are high, the cost of debt increases immensely. Vice versa, when interest rates are low, money is cheaper to borrow. Therefore, it's more cost effective when it comes to acquiring properties or developing properties. When the cost of debt is higher, that means in turn your debt service is a lot higher. So here's a quick, easy formula. You have your income from all your rents and such. You have your expenses where you're paying water, sewer, all kinds of services. So you get your income minus your expenses, and you have a lower debt service, means you have a higher cash flow. Vice versa, if you have same income, same expenses, a higher interest rate, therefore your debt service will be higher, lowering the cash flow. So the impacts of cost on debt. Next slide. Property valuations are also affected by the higher interest rates. The lower the interest, the higher the property valuation, because investors are willing to pay more because the cost of borrowing money is much lower. Conversely, with a higher rate, these valuations are a lot lower because investors want to compensate for the increase of the debt service that they're going to have to pay for that property. So here's an example with a 68 unit property purchased at 4.3 million with a 5-year hold. This property underwritten at 4% would have given you a 100% return. So pretty much a 2 times equity multiple, right? There, with a same property underwritten with a 6% interest rate, the calculation would have given you 85% return or 1.85 equity multiple. Now, in order to achieve that same 100% return, that $5.3 million property should have been purchased at a lower 5.1% or $5.1 million purchase price. Because of the higher interest rates, you needed an offset in order to achieve those returns. Therefore, this is just another impact of interest rates on the valuation of property. Next slide. Now, in regards to the cap rates, when interest rates are lower, investors accept a lower or more compressed cap rate, which drives the value of the property higher. In retrospect, when interest rates are higher, investors need higher returns on those properties in order to offset the cost of borrowing. And always that cost of borrowing reflects back to the debt service you'll have to pay for those properties. So therefore, it affects the cap rate. So as an example, right there, the calculation, the net operating income divided by the change in value has that direct effect on the cap rate. And Philip, please chime in if there's anything.
Yeah, I think here what's interesting, and I think in the prior slide you explained well the impact of the interest rate on the value of the properties. And I think at the end of the day, cap rates, it's really a reflection of the valuation. If you consider that the NOI is constant, right? If the only thing varying is the value, then it will have the direct impact on the cap rate, like we show in the formula. Lower value means higher cap rate. what we explained on the prior slide regarding the value, the direct effect of lower valuation when there's a higher cap rate is a higher lower valuation when there's a higher interest rate is a higher cap rate. I think this cap rate slide and the valuation slide, they're really saying the same thing.
So now the impacts of the interest rates when refinancing or exiting. So obviously, if a property was purchased, let's say 2021, when interest rates were at a comfortable sub threes, and the business plan included a required or refinance at a 3-year mark, the 3-year mark would have been here in 2024, pretty much. If that original business plan, the underwriting was starting at a sub three purchase price, and they had a refinance at 3.5, maybe 4%. That property is going to be going through some tough times because of the increase in interest rates here for the past couple of years. We've never been interested in business plans that require a 3-year refinance during the business plan because you cannot forecast these interest rates. As you can see, in the 2 years span when the Fed started raising interest rates, it has greatly affected a lot of properties. Therefore, with the higher debt service, so a lower interest rate, obviously, it's a great opportunity for investors to get more, favorable terms, lower debt service costs, and improves the cash flow. Conversely, with the higher interest rate, that increases the interest rate of that business plan. Those are not favorable terms. So most times than not, they're going to have to exit earlier as opposed to their 5-year business plan. And usually they would have to take a hit on that property if they cannot get another favorable terms, get another loan to meet that delta, the difference of the refinance to the new sale price. So I hope that makes sense.
Yeah, I think another way to think about this, when you work on a business plan on an acquisition, and then if you're considering refinancing, and also you're considering obviously at some point an exit, that's something to think about. What if the interest rates go up, go down? Obviously, if they go down, that's going to be favorable. If they go up, it's going to be against you. There are ways to think about either considering like higher interest rate refinance, for instance, is one way to be able to handle that type of worst case scenario. Is your when you're stress testing the deal, is your deal still being profitable if there is a higher refinance interest rate? But it's also, Jeff mentioned, on the exit, what if you need to hold the property for another couple of years? And in that case, it's going to be probably something to consider. You want to have a 7-year term loan, balloon payment in 7 years, if you plan a 5-year hold, because you don't want to be stuck at a point where you need to refinance at the end of 5 years and the interest rates are not there. So it's better to have a little bit of flexibility on the exit. And from that standpoint, anytime you can control the interest rate, meaning so it's a fixed rate, not variable, is probably a safer solution. And on the exit, the prepayment penalty, you don't want to be tied to the treasuries, which would be a conventional Fannie or Freddie agency loan. Often by default, they're going to be tied to the prepayment penalty will be the yield maintenance that is tied to the treasuries. And treasuries value can go high and low, and it's usually tied to the interest rates as well. There's a link. Those are all the things to think about when you're considering the impact of interest rates on an investment.
Yeah. All right. Thanks. So on to now investor demand. Obviously, favorable terms, favorable interest rates. There's more people looking to invest in real estate, for example. Now, the interest rates, the current higher interest rates puts a lot of investors on the sideline because of all the uncertainty. So when these deals are underwritten, it's always important to underwrite to what the current market is doing, the current situation. There's properties on the market that the sellers have nostalgia and are looking to get prices pre 2021, right? So it's important to underwrite at what the current cost, incurring the cost of capital is putting on stressors onto the acquisition of a property. When the business plan, it's always important to consider that. Therefore, higher interest rates put investors on the sideline. Lower interest rates bring all the investors out interested in making deals because the cost of capital is so much cheaper. Therefore, the market gets flooded with investors. It's a vicious cycle. Anything to add, Philippe?
Yeah, I think if you put yourself in the shoes of an investor who was considering a passive investment, I think indeed what is on the screen here, that's the reality. Low interest rate environment, the savings and other CDs interest rates will be low. So there will be interest from investors to invest in higher returns investments. And when interest rates are high, not only the economy and the environment is uncertain, as Jeff mentioned, but also there will be opportunities to put money in savings that are going to be, I think recently there were like 4 or 5% savings or CDs. And some people say, I just prefer to put my money into the super safe 4 or 5% than trying to achieve 10, 15% with higher risk. At the same time, it's usually a combination because higher interest rates means higher uncertainty in the economy, etc. So that's also will put some pressure on investors to reconsider their investment strategy.
Absolutely. Now, in regards to the rental demand and affordability, so as interest rates increase, the affordability of actually purchasing a house is actually just that, the opposite, less affordable. So a lot of people turn to their only option, which is to rent. As interest rates rise, affordability becomes less. You need more money to get into a property. Prices are still high, they don't fluctuate as much. So therefore, people turn to renting. When interest rates are low, though, the economy is stimulated because money is cheaper to purchase. So companies borrow money, there's job growth, there is increases in income per individual. So it's a more prosperous time frame. Renting a house versus buying still is still there's still issues because there's not enough housing to go around. But something you always consider is that whether the economy has high interest rates or low interest rates, there's always going to be a need for renting because there's not enough housing being built. But just know the difference in higher interest rate environment, people are priced out, which in turn have to take the other option, which is finding a place to rent until their money can go a little bit longer or further when it comes to buying property. And as a second bullet point, higher interest rates can impact occupancy rates and rental income because people lose jobs, there's layoffs, there's the whole trickle effect. So as interest rates go higher, companies stop borrowing money, there's less job growth, people lose jobs, and therefore those rent payers may not be able to make those rent payments, therefore moving out, impacting occupancy for the property and affecting the net operating income. And then it could affect your ability to pay that debt service. So it's all connected. So there's always those things to consider. All right, so here's a graph that, as you guys are familiar with, the Fed fund rate has increased from 0.25 to 5.50, 11 raises in a matter of months. So that has greatly impacted the economy as a whole. People are losing properties left and right. Deals are a lot difficult to underwrite that makes sense. So with the sellers still holding on to these properties, wanting those same prices as before, because it's such a short term that those interest rates increase. So there is an expectation. The Fed, I think, came out in that March may not be much of a change. They may not be lowering rates, but the next go around, which I think it's April or May, I believe, there are discussions about possibly starting to lower the defense funds. So hopefully that would be a way to forecast next steps on when you're underwriting a deal or looking to refi or sell a property. Anything you want to add to that, Philippe?
Yeah, I think it's interesting. I put in line the increase in the interest rates, the Fed rates at the bottom, and at the top you can see the cap rates. So that was something we discussed earlier, and just to see what's the effect of this tremendous increase of interest rates, like 11 times, going like 5% increase, and cap rates definitely turned in, therefore the values. And interestingly enough, if you look at the other examples here, like the increase of interest rates between 2004 and 8, it took a while for it to come in to have an effect on cap rates. And this one here between 2016, 18, 20, it was absorbed by the market. At some time it was a little more stable, but then it continued to go down, the cap rate. So the values it continued to increase in that period of time. So it's very, there's no two period of time that's where the market reacted in a similar manner. And I think at the end of the day, we're preaching to be very conservative, but so you always have to balance being too conservative, and if you're too conservative, you're going to miss the opportunities. But I think at the end of the day, I come back to stress test is the best. That's the best way to be prepared and have reserves as well.
All right.
That's all we have for you tonight. So Paula, I don't know if you have any question, or Eunice. Let us know, type in the chat. We'll stay connected for, well, but it's gone.
All right. Eunice, thanks for stopping by. If you have any questions or you want to reach us, talk about anything other offline, there's our email addresses. Feel free to reach out with anything you'd like to go over, any deals. Thank you for joining us, and we look forward to seeing you at our next Real Estate Accredited.
Thank you, everyone. Bye-bye.